Hi, and welcome back again to Tim Bigham's Options and Volatility Newsletter. We'll be taking a look today at a couple more vol capture trades as some huge repeat buying in CLSQ LAES sets up for a couple very nice vol capture trades. So let's jump in and take a look. First of all, here it is showing up on the scanner today. Checking in at number 2, over 25,000 of these Jan 4.5 calls traded. We'll see a second how much that exceeded open interest and how much it drove up implied volatility, but set up ideally for a covered call, a buy right, straightforward, simple trade right, and also a sell strangle trade. So let's jump in and take a look. First of all, here's that IV because of that big unusual call buying. You can see it had been pretty much just chopping around right around that kind of 100 level and below, right? And then lo and behold, saw the volume come in, just spike IV to recent highs, and basically at the highest level we have seen in several months. We can see on the long end of the curve too, right? The 120-day IV, because that's where the biggest volume was, right? We saw the biggest lift in IV. You can see here the Jan 26 expiration, right? A huge jump of almost 40%, and by far the biggest option volume, over 20 some thousand of those contracts, certainly accounting for a big chunk of that, those 4.5 calls. We can take a look at it on a straightforward basis going out with that 120-day option. You can see we did have a quick run up the pop and drop normally. This one an even bigger pop, so we expect at some point a bigger drop, which sets up ideally for a couple trades here. One of them a sell strangle, selling the out of the money 3.5 put, 4.5 call. So we actually looked at the 2 days when it was trading at about the closest today, right? We can see the stock closed at 392. 2 days ago, right, the stock closed at 399. So virtually the same 7 cents difference, but you'll see the huge difference in prices. So 2 days ago, the stock closed at 399. That Strangle selling the 3.5 put and the 4.5 call, both out of the money, with the stock roughly equidistant at 4, right, was trading a little over $1.25. The IV roughly 100. Both the calls and the puts trading at 100. Lo and behold, today, with that massive buying coming in, as you can see, 25,000 of these 4.5 calls traded, lifted everything. So that sell strangle with the stock virtually the same, down 7 cents, right? That sell strangle increased 65 cents. So with the stock down 7 cents, the puts were up about 35 cents. And with the stock down, the calls were up, right? They closed 60-cent midpoint here. They closed at 85 cents. So that sets up ideally for our next trade we're going to be looking at. But this is certainly a very nice way to attack it, right? Where you can get 65 cents more because of that huge vol pop of over 40 vol points. So a trade that 2 days ago was trading about a third lower price, you're able to sell it for about 65 cents more, simply because of that lift in implied volatility. As we talked about, we saw the calls actually up with the stock down 7 cents from a couple of days ago. That obviously sets up for the buy right. So the day's stock closed at 399 on Tuesday, right? That Jan 4.5 call closed, as we said, at 60 cents, a 101.52 IV. The buy right, which is simply buying the stock, selling the call to kind of hedge to lower your initial cost, right? You give up the upside above 4.5, but you certainly have a percentage-wise a decent amount of upside, right? So it pays 339. This is approved for every account out there. If you're approved for options at all, you can do a covered call trade. Lo and behold, fast forward to today, right, where we saw that huge, again, option volume 25,444 versus only 301 open interest. So someone obviously taking a big position is bullish on this stock. This is a way to lean bullishly too, right? You're buying the stock, which has 100 delta, selling a 56, so you are still net long. And this out of the money call, because of the huge lift in IV, the delta actually increases as well, right? When you look back to the previous day with the stock higher but IV lower, the delta was only 47. but because of the huge lift in IV, upward drift in option pricing, right? The delta increase with the stock going lower, which makes no sense except from an IV standpoint. But basically, you're giving up, about half of your upside for the stock, right? But reducing your costs in this case dramatically because those calls that were trading at 60 cents the day before, lo and behold, went to 85 cents. So you were able to, in essence, buy the stock 7 cents cheaper, sell the calls 25 cents higher because of that massive call volume, right? And get that buy right 32 cents cheaper, which is over a 10% drop with the stock barely dropping at all, right? Why? Because that IV pops so dramatically. So hopefully provides insight into how we go about identifying the trades and how we structure the trades to take advantage of it, right? In this case, leaning bullishly with that big call buying out there. In the case of the sell strangle, capturing vol on both sides as both the puts and the calls went up in price. So until next time, here's the good trading. Take care.